All right, welcome to The Explainer. Today, we're going to tackle a huge question, especially if you're just getting started with investing in India. How in the world do you actually build your first portfolio? Well, we're going to break it all down, from the big idea of diversification to a super simple plan you can literally start with right now. So, you know that old saying, don't put all your eggs in one basket? I mean, we've all heard it a million times. But here's the thing, it's not just some quaint advice from your grandparents. It is, without a doubt, the single most important rule in investing. And we're about to dive deep into what that actually means for your money. Okay, so what is diversification, really? Think of it like this. It's your financial seatbelt. Seriously. It's the one strategy that's all about protecting your hard-earned money from those crazy, unpredictable swings in the market. The whole point is to make sure one bad investment doesn't take everything else down with it. Right, so let's dig in. Why is this strategy so crucial? I mean, why isn't it just a nice to have, but an absolute must, especially for anyone investing in a market as dynamic as India's? Here's the deal. The Indian market, it's got massive opportunities for growth. But, and this is a big but, with that potential comes a whole lot of volatility. You know, those big ups and downs. So diversification isn't about trying to avoid risk completely. That's just not possible. It's about playing smart. It's about managing that risk so you don't panic and sell during the rough patches. It's your number one line of defense, letting you hang on for those long-term gains. And this chart, it shows you exactly what I'm talking about. See that crazy jagged line for the single stock? That's the roller coaster ride of volatility. But now, look at the bar right next to it, the diversified portfolio. It's so much smoother, right? See, the goal isn't just to get to the finish line. It's about having a much less stressful, more predictable journey to get there. That's how you build real wealth over time. Okay, so now that we know why we need to do this, let's talk about how. What are the actual building blocks you'll be using to build this portfolio? Let's break down the main asset classes. First up, we've got equity. This is your growth engine. Think of it as the powerhouse of your portfolio. We're talking about things like stocks and equity mutual funds. This is where you get a piece of the action, owning a small slice of companies. It's got the highest potential for making you serious money in the long run. But yep, you guessed it, it also comes with the most risk. All right, next up is debt. Now, if equity is the engine, then debt is the anchor. It's what keeps your ship steady. These are things like government bonds or the Public Provident Fund or PPF. You're basically loaning your money out for a fixed return. It's much lower risk, way more predictable, and it provides that crucial stability when the stock market starts acting crazy. And our third building block, these are your shields. Think gold, or maybe something like REITs. And in case you're wondering, REITs are just real estate investment trusts, a simple way to invest in a bunch of properties without having to buy them yourself. The cool thing about these assets is that they often do well when stocks are doing poorly. It's like another layer of armor for your portfolio. And this table just lays it all out perfectly. You've got equity for growth, debt for stability, and gold as your hedge or shield. The key takeaway here? It's not about picking just one. A really strong portfolio needs a mix of all three. You need the engine, the anchor, and the shield working together. Okay, so this all sounds good in theory, right? But you're probably thinking, how much do I put in each one? It's a great question. So let's talk about a super simple rule of thumb that can give you a fantastic starting point. It's a classic one, the 100 minus age rule. And the logic is actually pretty straightforward. Basically, the younger you are, the more time you have on your side to ride out any market slumps. That means you can generally afford to take on a bit more risk for the chance of getting much bigger returns. So let's say you're 30. You just take 100, subtract your age, 30, and you get 70. Simple, right? So this rule suggests you should have about 70% of your portfolio in that growth engine, equity, and the other 30% in your stability anchor, debt. Now look, it's just a guideline, not a hard and fast rule, but it is an awesome place to start. Now, this is really important. Building a portfolio isn't something you just do once and then forget about. Think of it like a car. It needs a tune-up every now and then. As the markets do their thing, your perfect balance is going to get a little out of whack, and you've got to fix that. Check this out. Let's say you decided on a 60% equity, 40% debt split. Then the stock market has an amazing year. Suddenly, you look at your portfolio and your equity has grown so much it's now 75% of the total. And yeah, that sounds awesome, but what it really means is you're taking on way more risk than you planned for. That's what we call portfolio drift.
So what's the fix? It's a simple concept called rebalancing. All you do is maybe once a year, take a look at your portfolio. If it's drifted too far from your target, you just sell a little bit of the stuff that did really well and use that money to buy more of the stuff that didn't. It's brilliant because it automatically makes you sell high and buy low, and it gets your risk level right back to your comfort zone.
Okay, I know what some of you might be thinking. This sounds great, but I don't have a ton of money to invest. Well, here's the best part. You absolutely do not need a lot of money to do this. You can start building a properly diversified portfolio with a surprisingly small amount. No, seriously, how little? How about just 500 rupees a month? Believe it, the magic tool that makes this possible is called an SIP, or a systematic investment plan. It's just an automated way to invest a small amount every single month. It makes investing super easy, accessible, and it keeps you disciplined. So what does a good starter portfolio actually look like? Well, a really solid, simple mix could be something like this. Put about 60% into an index fund, like one that tracks the Nifty 50. That's your growth engine. Then maybe 30% into a debt instrument like PPF for your anchor. And finally, the last 10% into gold, maybe through an ETF or sovereign gold bonds, for that shield. Just like that, you've got a simple mix that gives you instant diversification. So when it comes down to it, what's the single most important thing to remember? Just start. That's it. You don't need to be a Wall Street genius, and you definitely don't need to be rich. With this one powerful idea, diversification, as your guide, you now have everything you need to take that first big step towards building a secure financial future.